Facebook's results are out, and management has just finished going through the Outlook section of their earnings call. Shares are up almost 4% to just about $108. In this video, we're going to take the latest details and the latest guidance, plug them into our earnings model, and see if that share price move makes sense. So for this demonstration, we'll be using the press release from the investor relations page, and we'll also be using our Facebook earnings model, which you can download for free on our website if you click on the free models tab. You can quickly register and then click this page here. You'll have access to Facebook as well as all the other companies that we cover. And if you need a basic understanding of how this model works, click on the Education tab and scroll down to Facebook, where you'll find a full demonstration video. And there's also a guide to financial modeling. It's just general basic information, so if you're new to modeling, this would be a good place to start. And with that, we can get into it. So on the right-hand side of the screen, we have our model that includes today's updates and then the latest guidance from management. And on the left-hand side of the screen, we have the model that we were using as of yesterday that included the consensus estimates for revenue and non-GAAP diluted EPS. So to start, let's scroll down to the segment details and see how our estimates stacked up to what actually came to pass this quarter. So let's go down to the monthly active user growth rates. For the US, we had expected a 1% growth rate, and they actually achieved a 1.9%. So that was very strong, much stronger than what we had expected. While Asia Pacific was a little bit worse than we expected, and so was Europe. So overall, the monthly active user growth rate was in line with our total for the model prior to the release. Then on the average revenue per user, we had estimated that the US and Canada average revenue would be $9 per user for the last quarter, for the third quarter. And they actually broke $10 this quarter, so it was much stronger in the US and Canada than we had expected. And overall, the average revenue per user was just shy of $3, and we had expected $2.88. Next, we can move down to non-GAAP gross margin, which was well ahead of our expectations, and so was operating margin. Well, actually, operating margin was slightly below. Looks like less than 1 percentage point below. And that is as R&D was a little bit higher than what we had expected, and marketing sales was a little bit lower. Now let's get into some of the guidance for the fourth quarter. We are hoping that management would give us a view of the fiscal year 2016, but we didn't get that. But still, this is going to help us with our estimates. So they gave us a few pieces of information. On the revenue, they never really give a whole lot of information. They just talk about payments and fees, which are declining in line with the trend over the last couple of quarters. So not a real big surprise there. What we ended up doing for revenue is we kept the same revenue growth rates for the fourth quarter and really for the next 12 months, since that's the key to our price earnings based multiple valuation. And so you can see in this model, this just represents the quarter-over-quarter revenue growth rate. And so we just kept that constant to what the consensus had before. So you see there was expected to have 20% growth rate in the fourth quarter. It's still 20%, but that's on a higher base since the September quarter beat the expectation. So this is basically saying that if the analysts on average do not change their growth rates on revenue, this is what the valuation would be. But after such a strong quarter, they probably will increase their estimates a little bit. So that's how we got to our revenue number for the next 12 months. And then if we go down to the total 2015 expected GAAP and non-GAAP expense growth rates, they actually brought those down. So there was a range, and 55% on a GAAP basis and 50% on a non-GAAP basis represented the low end of the range, and they just flat out changed the range to that number. So we brought our expenses down for the fourth quarter. They also gave us guidance for 2015 CapEx to be between $2.5 billion and $2.7 billion, and they gave us stock-based compensation in the range of $3 billion to $3.2, so you can see we hit the midpoint there, and amortization of intangibles to be between $700 and $800 million. Again, hit the midpoint of that range. So overall, our revenue ended up increasing and our expenses ended up decreasing. So our EPS is now higher on a next 12-month basis. So prior to this release, the next 12-month consensus was 236, and now we are at, whoops, December 277. So obviously that's what's driving our PE multiple valuation, which went from 97 to 113, and on the DCF side, didn't change too much. Obviously the revenue growth rates helped a little bit with the DCF, as well as the increase in profitability because our expenses came down a bit. But keep in mind that when you do a DCF, about 80% of your total value, give or take, comes from the terminal value, and growth over the next year is not going to impact that too much. So overall, we'd say that the price move in after hours makes sense, and it actually could be a bit higher at the open tomorrow if analysts do in fact increase those revenue growth rates. If you'd like to download this model, just visit our website. You can tweak some of our assumptions or run some scenario analysis. And we know financial modeling is not for everyone, but if you're into this type of analysis, please give us a thumbs up and subscribe to our YouTube channel and share this video with your friends. Be sure to tune back in tomorrow for the Disney release, and thanks for watching.